It's a lot easier to sell a $400,000 duplex than it is a $40 million property. Everyone thinks, oh, there's so much competition in the duplex space. There is. But go ahead and look on HAR and see how many townhomes they have listed. While the competition is much more intense than it was 3 or 4 years ago, it's still nowhere near the townhome builders.
If I'm not willing to do business, I wouldn't introduce them to someone else to do business. I'm involved in multiple things. And finding the people who are similar in that regard is what has truly propelled the business. I'm not another agent's competition. I want you to come look at my property and bring your buyer.
I had investors constantly coming to me, hey, let me get in on the duplex action. There's a proper way to take investor money, and there's ways not to take investor money. I set up these smaller deals just like someone would set up buying a $30 million property.
If you met somebody at the coffee shop, what are the steps you're going to go to then get them to write you a $100K check in 6 months? Okay, so if you didn't know, Houston leads the U.S. in new home construction sales with over $43 billion awarded in 2024. So if you're a builder or you want to be a builder, this is the place to do it. And one of the number one things that you might encounter, whether you're a newbie, you have years of experience, is going to be funding. You got to fundraise, you got to find money to put these projects on the ground, to build new construction, whether it's single family, multifamily, whatever it is that you want to do. So today on the Blueprint Podcast, we're going to be talking about raising capital, building trust with investors, the different types of ways you can fundraise, different processes that you can go through, things you should and shouldn't do, all the things. And so to help you absolutely understand this from top to bottom, we brought in expert Mr. Ryan Johnson, who began investing in real estate in 2017. His experience includes land acquisition, infill development, large multifamily, and he's developed over $9 million of small unit multifamily assets in the city of Houston. Ryan is the president of Greater State Builders, a development and construction company firm based in Houston. And he's also a fund manager of the Texas Housing Development LP, an investment vehicle allowing limited partners to invest in urban infill development opportunities. His pipeline has 17 small multifamily projects that will be delivered in the next 12 to 15 months. So Ryan is also an anesthesiologist from the Baylor College of Medicine. So this guy's done it all. Got lots of unique experiences. We also have Laurinette Lewis in the house with Laurinette Group, which y'all have seen her multiple times on the podcast. So we'll hear a little bit more about her experience as well. So yeah, let's go ahead and jump into it. So y'all, thanks for coming on today.
Yeah, I appreciate you having me.
Yeah, absolutely. Before we get started, I also want to shout out our sponsor, Ross Wilkins with Lending One. You'll hear more about him later, but just want to give him a quick shout out. Thanks for sponsoring the episode, Ross. So yeah, let's just get into it. Do some quick intros. I know I just read your long bio there, Ryan. I know you're probably a little nervous about your bio, but why don't you just kind of tell us a little bit in your own words who you are, what you do, and how you got in real estate?
Yeah, so I'm originally from Louisiana. I lived in the city, like inner loop or near loop, for the last 23 years. Moved here after I graduated undergrad. Like you mentioned, I was a healthcare practitioner, still am. Went to nursing school in Louisiana, did grad school here, became a nurse anesthetist. Probably 8 years into my 16-year career doing anesthesia, I realized maybe I wanted to do something different.
Okay.
Started investing in real estate in 2017, buying land, did some flips, teamed up with a builder and started developing. I was holding the projects then, and then just kind of expanded from there.
Yeah.
Went into larger multifamily properties, started raising money for those. And then more recently, over the last few years, I've kind of taken the strategy of what large fund managers do for the larger properties and offer the same offerings for smaller properties. Because I had investors constantly coming to me, hey, let me get in on the duplex action. But as we'll kind of go over, there's a proper way to take investor money, and there's ways not to take investor money. And so I set up these smaller deals just like someone would set up buying a $30 million property.
Okay.
But I set it up in a very similar way to where the avenues and the processes so people can invest or 100% legit.
Yeah, love it. Cool. Laurinette, can you kind of give us your background in that? Because I know you've been in real estate 20 years and you've tried a little bit of everything. You've kind of you're a generalist, and I really appreciate that about you. Because any question I have, you have a story about it. So talk about kind of your experience in kind of fundraising, new construction on the development side.
So yes, we've done a ton of different explored a few different methods of fundraising, learned a lot about what not to do. I appreciate that you spoke on the proper way to structure those deals and accept money in fundraising process. So with the builders that we represent, most of them have some type of JV venture that they utilize for funding their new construction projects. And then personally, with some of the deals that we've done, we did a lot of crowdfunding, reaching out, very grassroots, organic, one-on-one conversations, more of an educational process for those people who wanted to invest on a smaller scale and weren't able to come in with larger sums of money. So we followed that process with them.
Gotcha. Okay. So Ryan, sounds like you've done a lot of multifamily, right? So I want to start there. Like, why do you believe in multifamily? And like Houston, it's, because of our, zoning laws, has become kind of the hot spot for multifamily. Everyone's building duplexes, fourplex, triplexes here. It's easier to do here than in other parts of the state of Texas. Why do you particularly like that asset class?
Like when it comes to small multifamily, I like it because there's a pretty big buyer pool.
Yeah.
At least I've found there's the traditional house hackers that are buying them. There's 1031 buyers. There's just normal investors. There's Airbnb investors that are buying them, and so I just like the buyer pool. Like if I'm going to, it's a lot easier to sell a $400,000 duplex than it is a $40 million property. Even though the buyer pool for a $40 million property is pretty big. And then as far as competition-wise, everyone thinks like, oh, there's so much competition in the duplex space. There is much more than there was 3 years ago. But go ahead and look on HAR and see how many townhomes they have listed. It's thousands and thousands of townhomes in the city right now listed, a lot of them sitting, and you look at the duplex market and there's 80 maybe all around the city. And so while the competition is much more intense than it was 3 or 4 years ago, it's still nowhere near the townhome builders.
Yeah, I love that. And I honestly think there's a marketability to it. I was telling someone the other day, I kind of can tell whenever someone's following trends, because there are these trends in real estate where people kind of buy things based off what's popping on social media. A couple years ago, Ghana was popping. Everyone was buying out property in Africa, right? And then it was Dubai, and now it's Houston, right? It's kind of the cool spot, like, hey, go buy a duplex in Houston. That's kind of a thing that people do. But also, I think at the end of the day, too, beyond the trend, it actually is genuinely a good investment, right? And so, yeah, I
mean, I think generationally, my generation, I'm in my 40s. They didn't grow up with we didn't grow up with Airbnb. We didn't grow up with pad split. Like I'm just learning what pad split is over the last year.
Yeah.
But the people, the first time home buyers now, they grew up in that. So for them to buy a duplex and rent rooms out, it's kind of like that's just everyone does it, right?
Yep.
Everyone in their generation is okay with that.
Yeah.
And so I do think like generationally, the first time home buyer trends have shifted, and whereas my generation would never have bought a duplex.
Yeah.
These generations are definitely looking at it.
Yeah.
Seriously.
Lornette, one of your first properties was a duplex, right?
The very first property we purchased was a duplex.
Wow. Okay.
And it was more so just the deal and the numbers made sense. It wasn't that, I mean, we're similar in age, so it was just in the neighborhood.
Yeah.
We were comfortable with the neighborhood. We were comfortable with the price, and it was a project that we could manage on the renovation side.
Yeah.
So very first project was a duplex.
Okay, let's take a quick break from the podcast because I want to show you that behind every episode, there's a full team making it happen. From our camera crew capturing every shot to our podcast editor fine-tuning the audio and our designer crafting each thumbnail. Just like that, behind every smooth real estate transaction is a great lending team working behind the scenes. This week, we're spotlighting Ross Wilkins with Lending One, our sponsor for today's episode. They're your go-to hard money lender for new builds, fix and flips, and even DSCR loans. If you need fast, reliable financing to get your next deal done, Ross and his team have you covered. Check the description for this video to get more information about Lending One and Ross Wilkins. All right, let's get back to the episode. So Ryan, I'm not pocket watching here, but it seems like you had a pretty good career in healthcare, right? You know, my wife works in healthcare. I know with anesthesiology, you were doing pretty good for yourself, right? So like, why go into the risky business of investing in real estate, right? Because I know everyone thinks everybody in real estate is killing it on the money side, right? But it's risky, right? And a lot of people lose a lot of money at the same time, right? So what kind of made you kind of feel like, okay, I want to leave this secure path line and kind of start dabbling in something that's, inherently really risky?
Part of it, entrepreneurship is fun. I mean, it could be risky, it could be nerve-wracking, but it can also be very exciting, very exhilarating. And so I like building, not only am I building a house, but I'm kind of building a business, a brand, a strategy, a company. There's a lot of building involved in entrepreneurship in general, as you know. And so that excites me. In healthcare, I kind of find it as like I have a super high income job. and it's very safe, and so you do have that security.
Yeah.
But I mean, healthcare is very much like takes like an assembly line approach these days, right? And so it's just you're there and you're cranking on the assembly line, and then it's just go, right? People are like, 20-minute lunch. Here, go take 20 minutes, eat your lunch. You're there for a 12-hour shift, and like you're just banging them out.
Yeah.
And so I like this definitely gives me more flexibility in my life in general.
Okay.
And so like I think the floor is higher. Because I'm replacing a high income, but the upside can be much higher.
Yeah.
And then I can kind of control my destiny, and I like having control.
Yeah. And was there like a moment where you were like, all right, I'm done, like I'm pulling the trigger, or was it kind of like a slow over the years, you were just tired of being on the conveyor belt and you're finally like, I'm ready to do this? Or was there a moment where you're like, okay, I think it's time for me, and what initially got real estate on your radar?
I was doing both forever, like
Okay.
almost like full time, developing duplexes and doing the larger multifamily, and then eventually it just got too much for me to do both.
Okay.
And so I stepped away from the anesthesia to part time. I still work the minimum hours to keep my license and to keep all my certification, so it's always there.
Yeah.
I paid $100,000 for that degree, and it took me 8 years to get there. So I'll keep the licensing and the degree, obviously.
Yeah. Okay. Lauren, I mean, I know you've also kind of at different points of your life have been like either hybrid, real estate, full time. Like, when do you think is for someone who might be in Ryan's position? Like, when do you think is that time to like make that jump? And like, when did you do it in your life?
I've always been in the construction industry, so it wasn't as big of a leap because it was something related.
Yeah.
So when I wasn't building or investing or representing builders, I was working in HVAC and construction wholesale. So I've always been in the industry.
Yeah.
What happens is, I think the entrepreneurial spirit, the control of your time. For me, the move was my family grew, and I wanted a different role in my family setting.
Yeah.
So years of being, high income producer, high risk, high reward, commission based, and working these super long, tedious hours. That's what prompted the change for me.
Okay, gotcha.
And it became not a slow transition, if you will.
Yeah.
It was, let's renovate this house, or let's flip this project. And one project became 3 at a time. And then 3 at a time became, we can buy land and build. And that went to building 12, and it just grew from there.
Yeah.
Until I looked around and was like, wait, I think we did too much. Wait, we're right back at that same situation. Let's figure out, is this the path we want to go, or am I going to take a different approach?
Yeah. And I think for me, my entrepreneurship journey started around the pandemic. And I think a lot of people were going into entrepreneurship because they were losing their jobs. They were just sitting at home, nothing to do. So the idea of like, quit your job and be an entrepreneur was like a thing, right? I was going to like real estate clubs, and people were leaving their engineering jobs to go do wholesaling, and they'd never done a deal before. I mean, that was like around me all the time. And so I like went full time initially in entrepreneurship and, marketing and real estate. And I think the timing was good, but also I think there's also this level I tell people all the time where I think there has to be attention. You know what I mean? Like, don't just do it because it's the hype thing to do. Like, do it because the timing makes sense for you. And so I think both of you guys have kind of like echoed that. Sounds like for you, it was, I'm sure that was really stressful, like working 2 intense jobs and kind of working through those. And so I think like, I always want to give people a soft skill on the Blueprint podcast. And the soft skill is like learning how to live in the tension, learning how to like live in the discomfort. And obviously I think that's something that, the level of that discomfort, you may try to get out of it, but there should always be some level of discomfort, right? Now the intensity of what that discomfort is, I'm not saying, hey, live in your car forever or whatever the situation is. But I think there's always that level. And so I just wanted to kind of drop that nugget in there before we kind of get into some of like the nitty gritty here, which is kind of how do we put these deals together, right? And so a lot of our content we've been talking about is more beginner level conversations for how to get started in real estate. So this conversation is going to be geared more towards somebody who's kind of already started and really needs to go to that next step, right? So if you're watching, you're going to get a lot of value out of this if you're a newbie and you've never learned it all, but this is really going to be geared toward people who, hey, you've bought land before, you maybe have done a duplex before or single family, and you're like, okay, how do I take this to the next level? And so I want to start with you, Ryan. How did you start initially putting your deals together? What was kind of the structure of, going to someone and saying, hey, I want to build X, Y, and Z? How were those deals structured?
I think they were structured. I have done joint ventures before, and I
Okay.
think this is where people can say get into a little trouble. You can get into trouble, right?
Okay.
And people don't really know this. It's like, okay, if you're going to do a deal with me, you're either a partner or you're a lender or
Okay.
you're a passive investor, right?
Okay.
If you loan me $100,000 and we write it we write a note, right? And we file that note. Even if I have a bank as a first lien and you're the second lien, you're basically my lender. That's completely okay. You don't have to have anything to do with the deal. I do the whole deal. You're lending me money. I'm giving you a return. Right?
Okay.
So that's one way. I have done it that way.
Okay.
Right. And then there's a joint venture, right? And a joint venture is you bring me a deal. You say, hey Ryan, I have this deal. I want to partner with you. And then we figure out how we're going to split it up, right? And so there's a deal. Maybe you could set it up into different buckets, like the deal finder bucket, the deal funder bucket, the loan guarantor bucket, the person that's going to do all the work. So there's different buckets, and then you could assign a percentage to those different buckets. It could
Right.
be like 20, 20, 20, 20, something like
And
that.
do you go to attorneys to do that?
On that, no. I mean, I
Okay.
have joint venture contracts, and you
Okay.
can kind of structure them. I mean,
Yeah.
it's always good to have. I mean, if somebody brings me an attorney-written document and wants to partner, I'm going to show it to my attorney and say, hey, what do you think? And where people get in trouble is, you have John Smith wants to do a deal and he wants to give you $100,000, but he doesn't want to be involved in any deals, right? And so that's where we can kind of talk about, okay, like, is he really involved, or is she really involved, or is she just giving you money and owns a part of the deal? And if it's the latter, if they're just giving you money and they're not signing the loan, they're not going to have zero involvement at all, it's basically you're selling them an illegal security. And everything might be great until something is not great. And then lawsuits start flying, and then the SEC gets involved and says, hey, what are
Yeah.
you doing? You're selling these passive investments, but you don't have a license to do that. And
Okay.
so there's, as you come across as a lender, a true joint venture partner, or you set it up as like a passive deal where, hey, we have an entity, it owns the deal, you invest in the entity, and then I'm not a broker dealer, so I have to file exemptions with the SEC.
Okay.
Yeah.
Got it. Okay. And do you have a preference, or is it literally just deal to deal, what makes the most sense for that deal?
I mean, I think it's deal to deal, but for now, for like the smaller stuff,
Yeah.
like let's say 10 duplexes, I would rather do it like a true, it's like a syndication basically, because it gets very complex if I have a joint venture with these two properties with you, and then with her with these two properties, and then with you with these three properties. There's a lot of paperwork involved,
Yeah.
a lot of different agreements, a lot of different splits. And so for me, it's like, okay, look, you're investing in this strategy. This is going to be your return. You get returns from all the properties, not just one or two.
Gotcha. Okay. So you would rather do a bigger deal and get everyone to fund, or your investors to fund into that one deal, than to go kind of one-offs.
Yeah,
and
or
kind
the
of-
way I have my current fund structured, I can keep adding one-offs to it. Right?
Okay. Oh,
And
gotcha.
so,
Into that fund.
into that fund
Okay.
to where you can keep growing it, keep growing it, keep growing it.
Okay.
And so you can kind of keep it going.
Yeah. Okay.
Yeah.
And did you start off there initially, or was that where you've kind of gotten more sophisticated over the years, or like what was kind of the initial deal structure that you did?
Yeah, I mean, I started just doing deals with my own money. I think
Okay.
it's if you can at the beginning, while you're learning, take your bumps and bruises with your own money. And so I was either using my own cash or I was using a home equity line of credit.
Okay.
Which really, using that home equity line of credit really juiced my real estate career. I bought a spec home in an appreciating area in Houston in 2012. Since then, it's doubled in value. I have a HELOC on it, and I buy lots with that HELOC even today. All the
Wow.
time.
Okay.
Nice.
Okay. So started off using your own money, and then using the HELOC, were able to get financing there. At what point did you stop using your own money? At what point were you like, okay, I've either capped out my own money, or hey, what was kind of the next transition?
Yeah, I mean, when I basically went up to bigger properties.
Okay.
That's when I traded up. And
Gotcha.
then they're
Okay.
like, in those bigger properties, let's say you need to raise $5 million. Might not be raising all that money. It might
Yeah.
be multiple people raising, multiple general partners. And so that's when I first started kind of understanding the syndication process. And I've done multiple syndicated deals. And then what I did was, I'm not doing any bigger deals right now. I just brought the same processes to like the smaller deals.
Gotcha. Okay.
Yeah.
Lornette, what was your kind of process on that? Was something similar, using your own money initially? Did you go straight to fundraising?
We bumped our heads a lot with our own personal money.
Yeah.
So definitely wasn't a fun process, but it was a learning process for sure.
Okay.
I think taught me more on the how to assess the deals and the risk associated with each deal. The largest project that we completed was 18 homes at one time. So not a large scale, but we were able to utilize personal funds, hard money lending, and some other resources to finally get it done.
Okay, so let's talk about that because we talked about essentially, you leveraging your assets, right? HELOC. Talked about leveraging just, hey, you got a high income job, you have access to resources, a blessing using those. You mentioned hard money. That's one that we haven't talked about as much. Where does hard money come in on kind of the process of funding?
For us, it allowed us to fund the land purchase. And then with the land purchase, everyone on our team was an expert in a particular area. So the CFO had been in tax and accounting for 20 plus years. I was in construction and sales. We had a marketing person. We had someone who was in wholesale distribution and material acquisition, and a previous developer who had contacts with the city, counties for utilities and things like that. So the hard money was a personal relationship with that company, and it allowed us to fund the land acquisition and then use the land with takeoffs to fund the construction per home. So we were pre-selling homes that gave us with deposits some funds to continue with the construction of each one.
Gotcha. Okay. So in terms of like the difference between y'all's both approach, so you're doing a fund and then you're kind of building more so, I guess, a company, I guess, more so in terms of how I guess any investor would be funding your group, your LLC to some degree. Okay. Yes. Gotcha. Okay. Knowing, and not to put you guys against each other, but I'm curious, like, how would you analyze how he did his deal and then vice versa? Like, what do you think about those?
I mean, a fund is basically a company, right? It's an entity that's registered. It could be an LLC, or mine's an LP, a limited partnership. And those people are owners of the limited partnership. So it's an entity in itself.
Gotcha.
And I have to file taxes for that fund and everything.
Got it. Okay. But you're just the only employee to some degree in terms of your
I'm the fund manager.
Fund manager. Yeah.
Fund manager.
Okay. Gotcha. Okay.
And in the fund documents, everyone gets a certain return.
Okay. So in terms of on the other end of, raising money, obviously you got to pay out your investors, right? So you mentioned there's kind of different ways doing that. So let's talk about, a JV deal versus a passive deal. What do those payouts look like? What kind of investor expect from a potential deal and those kind of varying degrees of investments?
I'll defer to you on that one.
I think it all depends on the deal and the risk associated with the deal and then the track record of the person. Right? And so I've seen actually a newer developer builder came to me recently and asked me to joint venture, and I told him I couldn't do it, but he had a pretty high return. I think he was giving like a 25% preferred return. Meaning that let's say whatever profit he makes on the deal, the first 25% goes to the passive investors, and then he takes the rest. That's pretty good. For it to be completely passive, but he was pretty new, and so that's a reasonable rate of return, because it's like maybe people would see him as a little bit more risky, and so you have to juice up the returns if you're going to. For me, I give like a 15 to 16% preferred return, which is also pretty high. But no upside. Right, and so you're capped. You put $100,000 in, you're capped at 15 or 16%, and that's it. I mean, even if we make 400%, you're getting your 16. Right? And you take the rest. And I don't have a waterfall. And a waterfall is people put in these waterfall structures, and let's say the first 8% you get, but then after 8 to 12, I'm getting some, and it's basically a level or a hurdle, right? So you get a certain amount, and then after that, then I get more, but those are much more complex, and I find sometimes they confuse investors. And so for me, like traditional large multifamily, they return like a 15 to 17%. That's kind of what they market. You could do 50% if they really hit it out of the park. And so when I've created this fund, I wanted to give like a multifamily level average return, which would be like 15 to 17.
And those would be passive investors essentially, right?
Passive investors.
Gotcha.
Passive.
So talk about the other two versions that you discussed. What do those returns look like?
I think as a joint venture, it depends on your role. Right? Let's say you're the deal finder. You might come to me and say, "Have this deal. I want to do this deal with you, but I'm not going to sign the loan. I am bringing the deal. I got it direct to seller, and you're going to be head of sales, marketing. Maybe you pick all the finishes or something, right?
Okay.
So in that situation, it's like, okay, like you're not taking that much risk, right? I'm doing most of the work. I'm building it.
Yeah.
I'm signing the loan. So maybe you would get 25, 30% of the deal, and I take 70.
Gotcha.
Now, if we're going to go in like 50-50 and you say, look, I have the deal, I'm going to sign the loan, you build it, I'm going to sell it, I'll take the fees on the sales, and then I'm going to work on the interiors, right? And there's a lot of people do that. Like I know a couple of builder teams that one guy gets it all framed up, and then he hands it off to the other partner, and the other partner finishes it out. Like, so working with the interior designers, picking out the tile. The one guy doesn't like to do that, right? He defers to the partner, and they both share the risk, they both share the work, and they split it 50-50.
Gotcha.
So it really depends on your role.
Yeah. Okay. Got it. That's good to know. Because I think, I've watched YouTube videos, I've heard people talk about it, but I don't know that really a lot of people really understand, the complexity that goes into those. And, because real estate coaches will tell you all the time, if you don't have the money, go find somebody, you know what I mean? Go find a mentor, right? And I think people throw those things around loosely, but they don't really necessarily understand value creation, right? In terms of, hey, what value do I bring to someone? How does that translate monetarily, right? And how do you respect someone else's value in a deal, right? Especially when it comes to we always say real estate is not emotional, but I think it is, right? Especially when you're dealing with large sums of money. There's no way you can't have emotions, right? So how people feel about their investment into a deal. Hey, you might have put a lot of sweat equity in, and you feel like you've earned just as much as the person who's done financial, but that person has so much more risk, right? In terms of when things go bad. I mean,
still to this day, I kind of do it as I call it the debt test. I get people contacting me on LinkedIn all the time. Hey, let's partner on some deals. Let's go 50-50. And be like, okay, are you cool signing all the loans? Oh, no. And that like scares the partners away real quick. I'm like, okay, like if you're not why do you think you get 50% if you're not doing any of the work or taking any of the risk? Like, you're not going to get 50%.
Yeah.
Okay.
It takes time to learn that.
Yeah.
So when I say we fumbled initially, it was that type of, emotionless real estate. And it was like, oh, we could, this is our team, we trust, and so forth. And we learned the hard way about being cognizant of that part of it, the sweat equity, who's signing, who has the responsibility if something goes wrong, and who's liable ultimately in the end. So,
yeah. Okay. So you mentioned the how we test, and I'm not gonna lie to you. I'm gonna need you to explain it, because I was looking through the list and I was like, okay, I'm not even gonna try to explain this. But so go through that if you can, and kind of talk about, I guess, how you use that to kind of vet through your processes when it comes to investors and the type of projects you're gonna go through.
Yeah. So the Howey test is like I guess there's 4 prongs of the Howey test.
Okay.
Right? Now I'll read them straight from the internet here. And so there's an investment of money. So you're going to invest money in a deal.
Okay.
Right? There's a common enterprise. So let's say we create a new LLC to do X deal. So the money is flowing into that enterprise, right? And the success of the deal is determined on the work of that enterprise, right?
Okay.
And then there's the expectation of profits, right? If you're investing in the deal, you expect a return.
Yeah.
And then the efforts of others, and that's really the key, is the efforts of others, right? Are you just giving the money and someone else is doing 100% of all the work, but you own a piece of the deal? You're really basically investing into a passive investment, but is it set up right? And so if all of these, any deal is going to be investment of money. Joint venture is like your entity is venturing with my entity. So we're not really setting up an entity, right? This is, you're setting up an entity and you're both investing into the same entity. And then if I'm doing all the work, or if someone else is doing all the work, then that should be the indicator of like, okay, this is a security, right?
Okay.
And so it's a security. Who can legally sell securities? I can't personally. It's broker dealers can sell it, right?
Yeah.
So am I a broker dealer? No, I'm not. So I file an exemption, right? And it's either a 506B or a 506C.
Okay.
Regulation D, and then rules 506C, 506B. And then there's different rules you have to follow depending on which one you pick.
Gotcha. Okay, let's actually break those down, and I put those in the notes, so let me know if you need my notes on those. But just break down the 506B versus the 506C, because I think those are, I think as I was reading through these, I recognize even personally, deals I've seen happen that I was like, oh, that was definitely a this, and they didn't do it the right way, right? So, yeah.
So 506B, a lot of people start out like this. People kind of think of it as like friends and family, right?
Okay.
So even though somebody's your friend and family member, if they're passive in the deal, you should go this route versus a joint venture, right?
Okay.
Or they can be the lender, right?
Okay.
And so 506B is I can do up to 35 non-accredited investors and unlimited accredited investors. And,
Okay.
Basically there's multiple, I guess, qualifications of an accredited investor, but for these purposes, it's like, okay, if you're single, have you made $200,000 per year over the last 2 years? If you're married, have you made $300,000 per year over the last 2 years?
Okay.
And or do you have a net worth of $1 million, not including your personal house, but it can include your 401ks, other rental properties that you have, everything. And can you prove that? Right now, there are other, have you taken the Series 7? Have you taken this test? Are you a broker dealer? There are other things that qualify you to be an accredited investor.
Okay.
But probably for the purpose of this conversation, usually it's like income and net worth driven.
Okay.
Right. And so, if it's a 506B, I can take people that don't make that, but only 35. But here's the kicker. You have to have a documented relationship with them, right? And so I can't meet someone at a coffee shop and they're not an accredited investor, and the next day they invest in this non-accredited deal that I have.
Okay.
Right? I have to have a documented conversation with them. So I meet them day one.
Okay.
And then maybe day two, we have a phone call, and I'm documenting that with my CRM. And maybe the next week we have another phone call and we go over the investment. And then next month or in 6 months, I release a deal and it's not accredited. I can say, hey, look, I can prove to the SEC, hey, look, I met this person at a coffee shop. I had a conversation with them on this day, and I'm documenting all this stuff. I had another conversation with them on this day. They completely understand the deal.
Yeah.
They invested 2 months later. Okay, that's a legitimate relationship.
Okay.
Now, if it's your worker, like, okay, it's my coworker. Okay, like that's all you would need to put is like, okay, I worked with this person for 3 years.
Gotcha.
They can invest in the deal.
Okay.
Right.
Got it.
And so the kicker with the 506B is you can't advertise, right? So if I have an email list, I can send out an email saying, hey, I have this non-accredited deal open, but you can't run Facebook ads. You can't put it on a billboard. You can't go on the radio and talk about it. You can't publicly advertise at all.
Okay.
Right?
And they don't have a minimum amount that they can give though, right? Because I mean, you're talking only 35 investors. I mean, you're talking, if you're in a big project, that means those 35 have to give substantial amounts of money.
No, but you can only 35 non-accredited.
Oh, non-accredited. Okay, that's
unlimited accredited.
Gotcha.
Right?
Okay, got it. Okay.
And so no, there's no minimum. Usually the minimum is up to the sponsorship. Right?
Okay.
You can even have a minimum of 100,000, but someone comes to you and say, hey, can I put in 30? You can take it if you want.
Gotcha. Okay, got it. Okay, and now let's go over 506C.
506C is like you answer yes to all those questions. Like, have you made 200 or 300 over the last 2 years? Do you have a net worth of $1 million or more, not including your personal house? And there are multiple others. I mean, if you want to read them, I'm not sure if you have them in front of you.
Yeah.
And then can you get verified? Because if it's a 506C and after you sign the docs, what we do is we send someone a third-party link, and then they deal with that third party, and then that third party produces an accreditation letter saying, hey, look, if it's income, okay, show us your last 2 W-2s, right? Or show us your tax returns for the last 2 years. Right?
Okay.
If it's net worth, okay, show us your 401ks, show us your schedule of real estate that you own. Show me how. And then we don't deal with any of those documents. It's completely third party, and then they send a letter to us saying, yes, this person is verified, or no, this person is not verified.
Okay, gotcha. Okay, and you were learning this stuff as you were doing deals, right? Or was this something that you went to a coaching program and they taught you how to do all this?
I did do some like larger multifamily coaching programs, and it was introduced, but just doing it with other people that maybe I wasn't the primary sponsor in the deal.
Okay, gotcha.
It was like a co-sponsor, you call it.
Yeah.
So
okay.
Yeah.
And I think that's something that Lornette, I think you've done really well. Is it seems like you seem to find the people who are doing things and you build teams really well. And so I think that's something interesting for the folks who have kind of started is like the skill set of knowing how to build your team, right? How to put yourself in the room so that you can absorb by osmosis these things, right? So if you're just I know a lot of people are very just trying to do it on their own, right? And I get it. I mean, if you've been burned before, there can be that mistrust. So I think learning how to vet people and how to build trust, and then learn the knowledge that I don't have so that you can continue to become more and more sophisticated. Because I think it just opens up more doors. Because everything I've heard you say, Ryan, that just tells me, okay, I can be more creative and more effective if I know these other tools, right? If my tool belt's limited, then it feels almost impossible sometimes. So just knowing those skill sets, I think, is really really helpful.
No, definitely.
Yeah. Sure. So let's talk about the kind of the trust building process, because you mentioned, documenting the process, right? So to me, that's a sales process too, right? I mean, the SEC wants you to show that you know how to educate somebody, how to convert somebody, right? In a healthy way. So I want both of you to kind of talk through your process for, if you met somebody at the coffee shop, what are the steps you're going to go to then get them to write you a $100K check in 6 months? What would be the process you go through? So Lauren, I want to start with you first.
100K, huh?
Mm-hmm. Or hey, if you want to raise it, whatever your number is.
I think generally I just have a very authentic, personal approach to everything that I do. I'm personally involved in all of my projects somehow, some way. So there's skin in the game as far as again, if it's just the intellectual guidance, if it's connection for relationships, if it's being at the project doing construction management and project management, if it's the sales process, like I've been a part of all of that. So generally it's first understanding what their true intention is. I think I, more than anything, just listen very well. And I'm not rushed to do too many things. Okay. So it's really listening, understanding what they want, because I can hear I want to invest in properties and great, I have X, Y, and Z and you can do this and talk to this person and it doesn't align, it doesn't connect. And then at the root of that connection, it's me. And it's like, why did you send this person to me? Why did you bring this person to me? And did you know them? Did you vet them? So I think generally to have a personal relationship, get to know them first. Okay. Really understand what they're wanting to do and what they're capable of doing, because those are two very different things. And if I'm not willing to do business, I wouldn't introduce them to someone else to do business with them. So outside of that personal approach, it's I think a educational conversation that I have. So this is how, this is why, let me know where you are in that. Is it feasible for you to understand, or again, like, what is your role going to be in this this process? So and then outside of the high level, that part of the conversation, then I'm boots on the ground for the rest of the project, typically in most of my ventures.
Gotcha. So. Okay, I love that. What about you, Ryan?
I think it's definitely marketing. Let's say I meet the person at a coffee shop. We exchange numbers. I may say, hey, look, give me your email, I'll send you some info. Right? I'm going to put them into my CRM. Boom,
what CRM do you use, by the way?
So I just switched from Active Campaign to Go High Level.
Oh, yeah. Okay.
I'm just getting warmed up with Go High Level. I'm not the best with it. I was great at Active Campaign. And so I just switched over. So I'm still warming up with that. But let's just say I meet someone, or let's just say someone clicks on my website, right? It might say, hey, get information on future investments. That's going to send them an introductory email, and I'm going to send them a drip campaign, right? I want you to know me, even though you don't really know me, right? And so, this is who I am. This is who my family is. This is what I do. And they may get an intro series, and of course, if I can get a personal phone call with the person, I'm more likely to close them, right? And then you're following them on social media. So, like, hey, follow me on LinkedIn. Instagram is probably not my thing. I think, for me, it's easier to raise money on LinkedIn. For sure, 100%. And so I'll say, follow me on LinkedIn. You're going to see some of my content on LinkedIn. You're going to maybe like some stuff. The algorithm's going to feed you, right? And so by the time you eventually invest, it may take 7 touch points with the person, right? Some people may say, oh, I love it. Let's do it right now. But some people would be like, I don't know. And then they say, okay, look, you're doing deals. You have to show proof of concept, right? This is what I'm doing. Oh, we just built a duplex. We just sold it. Oh, we just built more. We just sold it. Okay, like, this person is like, I'm seeing them repeat steps. Okay, let's try it out. And so I think of it like that. It's just like it's a relationship building, but it doesn't necessarily mean I'm taking you out to dinner every day. Even though you want to go to dinner and drink, let's do it. However, it's just you have to show proof of concept and proof to know what you're doing.
I love that you incorporated like the social media element of that. But I'm interested though in like the emails, right? Because I think social media is the one I think people default know that they should be doing, or if they're not, or they are doing it. For me, that's more natural. So I immediately go to social media, right?
Yeah.
The email. I just recently got challenged by somebody who's sitting on this podcast to send more emails, right?
Yeah.
So I'm like, okay, yeah. Well, how do we do that? So, what's been kind of your route there? 'Cause I think social media is one of those things where you can see success easier. I think email tends to take a little bit more time. What's been kind of your process there?
I mean, I think the process is like, if you're gonna find leads on social media, the goal should be to deplatform them from social media.
Yeah.
Because if you're platformed, then you rely on the algorithm, right?
Yeah.
Maybe it's in your favor, maybe it's not in your favor. Right?
Yeah.
But if you can deplatform them and say, hey, look, let's whether it be a form or maybe it's just a personal ask, like they send you a LinkedIn message like, hey, I'd love to learn more about it. Okay, great. Give me your email.
Yeah.
Okay, now I've deplatformed you. You're in my world now. And then I'll send just touch
Are you using ChatGPT to write your emails, or you're sitting there, you're just writing them in?
I'll use ChatGPT to edit it.
Okay.
But I want it to be authentic, right? This is not like coming from, I don't want it to sound like too generic.
Yeah.
And a lot of it is personal.
Okay.
Once you're investing in the deal, or maybe if you're thinking about investing, I have a photo stream, right?
Nice.
And so it's okay, like, hey, look, check out some of the stuff we're doing. Like, you could check it out on Instagram, but like, we're at the projects every week. Like, here's the photo stream. Join it.
Yeah.
Right? So they're just constantly saying, wow, okay.
Yeah.
Wow, okay. And so it just kind of like you're building their relationship slowly.
Yeah.
But yeah, definitely emails work. And then when you have a deal, that's the thing, is like, you can't just meet someone and then you have a deal and expect them to trust you, right? So you're developing I know this person, I like this person, I trust this person. Okay, I like this deal. Let's do it. So no one's going to invest in you unless they know, like, and trust you.
Yeah, absolutely. Okay. Yeah. And I think that's something that I've started to kind of refine recently, is the idea of how do we get people to trust us beyond the sales process, right? How do you get through that barrier? Okay, I actually genuinely I like this person, right? Like even if I never did a deal with this person, like I would be okay with just having that person in my ecosystem, in my sphere of influence. And I think that another soft skill, right, is actually caring about people. Right? So you have to actually look across the table at the person at coffee and be like, does this person need to invest in my deal? Like, would it actually help them, right? And something I've learned in sales is you have to believe in your product to be able to say, hey, this might be a challenge for them. Like, hey, they might not have 100K, but they need to get 100K because I'm going to help them make 200K, right? So I'm helping you by selling you, right? But if my heart isn't to help you in the midst of that, then I think that's when you get into the bad deals, why the SEC exists, right? To protect people.
Yeah, I mean, I have told people that I'm not going to take their money before. People are like, oh, okay, I want to invest in this deal. And then when you kind of start hearing the backstory, I'm like, man, like, I don't really know that you're in the position to like give me this money, right? Like, why don't you like try X, Y, and Z and then come back with me, just because, once you give me the money and it's in a project, like, you can't come back and say, oh, I need the money back. And then it's like, oh, okay. Like, now I have to back raise to get you out. And so I always, there's like a saying in capital raising, it's like the person that's going to stroke you a $250,000 check, you'll never hear from them again. You might never meet them, right? It's like, oh, I've been seeing you on LinkedIn. I like what you're doing. I'm going to drop $250 in this duplex fund. We're like, wow, okay. Like, you want to you want to hang out? You want to come check it out? No, I'm good. I'm good. Just do it.
Yeah.
And you never hear from those people. Like, they don't reply to any emails. They just like, I send them the K1 at the end of the year, and it's just like a complete silent, passive person, right? But then the person that gives you $25,000, they're gonna be texting you every week.
Yeah.
Just because that maybe the person that's in that position to cut the $250 check, they're in a much different position financially than the person that's like kind of scraping by, risking the 25, which 25 is a lot of money. Don't get me wrong.
Yeah.
But it's just they're just at a different level in their maybe professional career, investing career. And so I have told people, like, I don't think this is going to be the right thing for you. Right?
Yeah. What's your strategy on LinkedIn?
In LinkedIn is kind of different in that you can filter it, right?
Yeah.
You can filter it. Most of my investors are healthcare practitioners.
Okay.
Just because I have that immediate connection. And so you can really niche down. I mean, there's fund managers on LinkedIn that were, for instance, there's a gentleman, his name is Sam Silverman. He's on LinkedIn, right? He's probably raised $50 million on LinkedIn, right? And he was a tech sales guy, right? And so you know who he sells to? Tech sales guy. Right? And so he knows the schedule. He understands the workflow. He understands who to target. And so it's just, you can filter it down to profession.
Okay.
Right? And so I think it's easier in that sense.
Yeah.
And just connecting, DMing.
Yeah.
It's just a little bit easier. Like you can't search Instagram, tech sales guy, Houston, Texas. You can't, but you can filter that in LinkedIn.
Yeah,
right?
absolutely.
And most people will be there if they're like a high income tech salesperson.
Yeah.
Right. And so I do the same thing, but I'm in healthcare.
Okay, gotcha. Yeah. And I think LinkedIn is one of those places you got to show your work,
You do.
right? Instagram, you can kind of fake it. On LinkedIn, like you can't fake it, right?
Yeah.
And so I'm sure somebody's figured it out, but like I think you definitely, like you said, having the proof of what you've done, I think that's a really good tip there. And then I think also the thing that I like about LinkedIn is that it takes a little bit more intentionality. Right? Like it's not as passive where Instagram, we kind of just scroll through. I think the people who use LinkedIn well are writing thoughtful comments. They're kind of going out of their way. The challenge I've had with LinkedIn, and you can kind of give me, maybe we can talk offline, is I've noticed that there are a lot of people who don't use it. So it's harder to find the people who are active, who are going to see your content, who are going to take the time to filter through and actually get to your content. And so maybe it's a skill set that can keep getting better at. But I think that's a really interesting point, being able to niche down and get really specific on who you're looking for.
Yeah, I would think like niching, at least in my experience, niching it was much more successful than just throwing this wide kind of shotgun approach where I'm trying to anyone and everyone can come.
Yeah.
Right. And so for me, like I start out connecting. And then, so now if you look at like you can look on LinkedIn, like, okay, of your followers, like what field are they in? And right now I think it's like 45 or 50% healthcare, 30% real estate. And then the rest is just kind of like random type things.
Gotcha. And we'll put Ryan's LinkedIn in the description so you guys can check that out. Laurinette, who do you think your niche is? I know it's probably heavy real estate. It's probably 80% real estate.
Mostly real estate. So initially I thought it was investors, and then I realized there's levels to that, and it's not necessarily my ideal person, because the ones who connect easier are not at the level that we need them to be, and that's where like that emotional weight and tax comes from dealing with certain price points in investing, and then it has pivoted to real estate brokers, agents, people with other specialties, like you and I connected in a real estate world, but we have many more things in common. Much more, a lot more. Things in common other than real estate. And with the multi-passionate person that I am, and like you said, I have a story for everything. I've done it all. I'm involved in multiple things. I think finding the people who are similar in that regard is what has truly propelled the business. I call myself the agent-friendly agent. I'm not another agent's competition. I want you to come look at my property and bring your buyer. There's no ego in working with me, and I think that has been truly what has propelled the business.
So interesting enough, Laurinette had a previous business called The Blueprint.
I did.
So when we're talking, and I'm like, I got a podcast called The Blueprint. She was like, no way. And then, so like, we may need I don't know, we're gonna have to collab on something to bring in. I love that.
It started with business owners, so that's how we got the name. I was in construction, I was in that world, that realm, and Blueprint Consulting, and then turned Blueprint Consulting and Marketing. But it was working with business owners, again, people who wanted to invest because they were business owners and had liquid, thought they were ready to go, and it was like, this is not the emotional roller coaster that I need to be on right now.
It's pivoted.
Yes, really quick.
So let's talk about parts of the city that y'all like. Ryan, you seem to be kind of all over Houston. So is that strategic, or is that just like, hey, where are the deals at? I'm just following the deals. Where's your?
No, I mean it's very much strategic. I mean, I think that if you're thinking of small multifamily, I mean, like I would say like Medical Center South and like Acres Homes area kind of dominate, right? Like, as far as like the volume. I started out doing most of the stuff in Medical Center South, Sunnyside, that area. Kind of switched to Acres Homes. It's much closer to my house, so it's much easier for me. I'm starting tomorrow 3 more kind of down in that Medical Center South again. And so I think just the different buyer pools is like the people that are looking to be on the south side want to live on the south side. The people that want to live on the north side, there are pluses and minuses about both areas. Medical Center South has the med center, that's great, but north side is growing. I mean, it has like the Heights has just exploded. The deals that I'm doing right now are 12 minutes from the Heights. And so I like the north side in general.
Yeah.
You see like, HEB has land under contract at Pinemont and Ella. You're seeing Target is doing they bought the Sears location on Shepherd. So like if these huge retailers are building up on the north side, 8 minutes from these job sites, like they're buying and building for the future, not necessarily now.
Right.
And then I do think like the center city, like I'm going to start some projects here soon, like in the East River area, and just different buyer pools, right? Some people want to live downtown. Some people go to go to the south side and they want to live on the north side. I'm also looking at lots kind of like a little bit more suburban, like going toward Katy, going toward Tomball.
Okay.
Just because I get a lot of buyers that like want to do the house hacking strategy, but they don't want to live in the city.
Yeah.
And so I think that if you look at like in the kind of pushing out, there's no product out there.
Yeah,
right?
is the permitting out there a little bit harder, or has it been?
Some of it is a little bit harder. Some
Okay.
of it is like, you might have to buy some land, but they don't have any utilities, right? And then you have to run the utilities to it. So that makes it a little bit more pricey. But we're definitely been looking out there.
Okay.
For sure. And so I think I don't want to just base all my operations just in one geographical area. I know a lot of people like to do that. For me, it seems like, it seems a little risky for me. It's like I want to hit different price points. So I have product that's mid 4s and 5s. So it's completely different buyer, right? And then I want to be a little bit geographically diverse.
Yeah, love that. Lauren, I know you're like all over the map too on the price points. We were talking today on our sales meeting, and we have builders at 270 to 300, all the way up to like $1.5 million, 2 million. Yeah,
279 to 2 million right now.
Yeah.
Originally, we were looking at location based and live in the Heights area, so it's like a work, play, live situation. The families there, it is just comfortable. But we've represented builders as far north as Woodlands, Conroe, out to Baytown, Beaumont on the east side, Katy, Fulshire, going west side, and then Pearland, Manville, going on the south side. So generally, over the almost 20 years, we've been in all parts of the city. What we tried to focus on at one point was lifestyle. And we were aiming towards luxury product, which is a comfortable price point for us, and finishes and expectations and customer experience. And then that led us down south to the Galveston area and, the building process, permitting, and needs and material delivery and delays. And it was just like, okay, we're going to go back up a little further north.
Yeah. Well, perfect timing because, Galveston is struggling right now.
Yeah. So we closed out the last project down in that Galveston County, Texas City area a year and a half ago.
Okay.
And I think we're going to stay a little further north. But again, focusing on lifestyle. So is it inside the loop? Are we looking at walkability? Are we looking at price point specific? Are we looking at that work, live, play concept for the buyers that were the end user buyer? So.
Yeah. Okay. Well, I like that diversification that both of you guys are doing. I think that is, I think it's unique because I have heard a lot of like niche down, find your market, and like when things are going great, that's amazing, right? But I feel like in probably the last decade, it just feels like there's always something big happening, impacting the market.
Niche down on location, like in the Heights specific, our product has changed multiple times over the years. Originally or a while back, it was a small 2-story like in Cottage Grove. Then we went to the 4-story, then the 3-story, but everything had an elevator. And then now we're back at a 2-story townhome linear style. And now that's stopped and we're at 2-story traditional feel. So even when you niche down, I think location wise and price point wise, you still have to listen to the market and what people are asking.
Do you think buyers are just looking for the next big thing, or like what makes the product change like that?
I wouldn't say next big thing. It's accommodating who's living in the area, because also the demographic in that same area has changed. My buyers are not the same individuals as they were even just 2 years ago. So as their needs change, as we're now more flexible in work capacity, people are looking for different features and amenities. It's not just location, but they want to be in that area. Multiple things have changed. So location, lifestyle, product, all of those things are a part of our conversation when we're working with builders.
Nice. Do you think, Ryan, that you're going to diversify your product? Because you've been pretty heavy multifamily. Do you think you're going to stay that, or do you think you're going to start adding in a different asset class, or kind of what are your thoughts there?
And I would say right now I'm going to be 80% small multis.
Okay.
I think I may do a few townhomes, and I have a been looking at a lot of lots like kind of around the heights,
Okay.
or just outside the heights.
Yeah.
That might be like maybe better for townhomes.
Okay.
And so, you know, I'm a little hesitant to go compete in the townhome market like in acres homes, because there's just so many of them.
Yeah.
Right? And so in that area, it would be small multi.
Okay.
But maybe like in the Heights area, it would be townhome, because the lots are more pricey.
Yeah.
And so if I can stick three townhomes on a lot versus one duplex, maybe it makes sense to do 3 townhomes.
Yeah, that's why. So we have a builder in 77009, which is near Northside or Ryan. I need to find like somebody who's who knows Houston and understand like why both of those neighborhoods show up on there. But we really like that one just because of the proximity to the Heights, but then also just seems to be like a healthy mix of like fix and flip type products where you have more historical, you know, a single family house, the ADU in the back, but then also you have a townhome product. And then I haven't really seen a lot of multifamily in there as much, but that may be, I'm kind of
older.
Yeah, it's like a lot of like a rehabs, multifamily. Yeah, so I kind of like, that's an interesting market as well that we've been looking at. And honestly, wasn't really on my radar until we started working over there. And I was like, wow, I think this might be a little gem, right? There's a lot of bars and restaurants in there that I think a lot of people go to, but they just go there and then go somewhere else in the city. But I think people are familiar with it. They just haven't spent time there.
I think that's the education point of understanding where you are and talking about it, not just from your project perspective, but why this is where you chose to be.
Yeah.
So a lot of what we do, even if we don't have any, well, we always have something under construction, but if there was a lag, even when we weren't building in the Heights, we were still talking about the Heights. When we weren't building, you know, up further north near Acres Home, we were still talking about the neighborhood. So it's still ways to be present, even if the project's not active.
Absolutely. So Ryan, what's the future for you? So been doing this for a couple years. You've had some success. Do you think it's like, hey, I'm going to keep doing this? Or do you anticipate any pivot in terms of business model coming up? What's kind of the next step look like for you?
You know, the construction company is new for me. So before I was just a fund manager / developer.
Okay.
And so I realized once I had an inventory of like 20 to 25 lots, I'm like, okay, you know, this is I can basically build a construction company with my own inventory, right? I'm not out there hawking fee builds. I can just fee build for myself. I can joint venture with my own fund. And so it's that is new for me. And so the 17 projects that I have coming up out of the pipeline, those will be mine. That where I'm the developer and I'm the builder. And so I'm just focusing on that, building out systems for that company, improving, hiring. You know, we're onboarding like a construction manager now. And so just that's going to be like my next 2 years. It's just kind of fine tuning that, keeping the lot inventory loaded, just to where I can kind of keep feeding the construction company.
Got you. And is that essentially creating a flywheel, I guess, so that you can control all ends of the process? Is that the reason for that?
100%. Like how my process is normally is like, I buy the lots with my own money, with the home equity line of credit, with maybe a private investor. I get the lots fully permitted because I would never want to sell a bad lot. I'm not speculating on land, right? If my fund is going to buy a project from me, it has to be like ready to go. Permits in hand, plans are there, everything's ready to where it's like it's an easy transition. Just like, okay, the fund gets it, start building. And so really on development, you can get burned on the land play, right? Especially like, because you buy this huge tract of land, you think you can put 20 houses on it, and the city says, oh, you know what, we're only going to let you put 8. Well, you paid for it because you thought you were going to do 20, so you overpaid, now you're in the hole, and you're trying to get out of it, or you're trying to just sell the land. And so I never want to be in that situation, and so we speculate with our own money or just with JVs, and then once the fund is ready to take it, this is like this project is shovel ready, it's ready to go.
Nice.
And then the construction company now builds for the fund.
Got it. And then I want to, for our producers, I want to bring Ross on to ask his question. But Lorna, I want you to kind of answer the same question, kind of what's next for you. Obviously, team, continuing to sell the product, grow the team, all the things. Where do you think you're going next, knowing that you've had some projects where you learned a lot, right? Are you gun shy with the next project? Do you think it's like, hey, I just need to kind of lick my wounds and I'm gonna get back out there? What do you think is next for you?
Absolutely. It's growth. It's building, and I'm still working on identifying what that build is. And so far we've been talking about building just, again, the relationships, the pipeline, our skill set, making sure we're ready for when the next opportunity is present. So the team was a big part of that, staffing and having the agents on board, and just working with our builders that we have currently, exploring other opportunities and just being open.
Yeah, nice.
I'd like to add something before we get to the question.
Yeah,
it's
absolutely.
I'm not an attorney. Right? I'm not a CPA and I'm not an attorney. So anything that we talked about that today, don't make any legal or business decisions on anything, any tips that I gave. If you're going to set up some type of real passive investment and try to apply for an exemption to sell a passive investment, you should 100% not use ChatGPT. You should hire a securities attorney. They have, they're attorneys, but they have like a special focus on doing these types of deals. You should 100%, because ChatGPT may be able to spit out documents, but if you get into trouble, they're not going to defend you in court. And so everything that we do, we have a lawyer create all the documents for us. So.
Good CYA there. Another real estate soft skill.
That's the final cut.
Absolutely. And I guess expand on that one more time before we move on. Like, where would you recommend someone go to as their first? What is their next phone call? Should they call the attorney first? Is there another content creator out there that you know of that's putting out good education content on this? Any books you've read?
There's I forget his name's Mauricio. I don't know. There are syndication attorneys out there that are putting out content just like you're putting out right now.
Gotcha.
I'm sure if you Google it, if you look on LinkedIn, I mean, they're all over the place. And then, I'm happy to, if somebody's really serious, I mean, if they contact you, I'm happy to refer my attorney as well.
Gotcha. Cool. All right, Ross, what question you got?
Basically, I just want to know what, for you, what goes into the thoughts of you wanting to keep the fund going? Because it sounds like you're buying the land already with your HELOC. You're already pretty much well capitalized in acquiring land. You have the building company going. So what makes you decide to say, I'm going to go out here and raise money, I'm going to do that, as opposed to just, getting with a lender and they're going to fund 90% of your loan to cost?
Yeah, I mean, when for instance, I just closed 3 loans today, actually, with I guess you could say like an institutional hard money person. So they were like 85% loan to cost. But when you look at the equity that we need to do the 3 projects, these are like 3 Southside projects. It's the land costs, still have the builder deposit, still have plans, permits, impact fees, and so still have quite a bit of money tied up in those. And so if you can move a lot quicker and build something at scale if you're willing to give some returns away. And for me, I would rather use my own money to go buy the lots and kind of get the next ones loaded up, right? So for instance, we have 5 going right now. Those will hit the market probably January, February. As soon as those sell, I have 5 more loaded up to where it's just okay, keep going, just keep feeding it. So we're always buying land, or we could use lenders to buy that as well. And then so it just makes it a little bit more flexible, right? I'm not having to. I'm the fund manager. I can just go and take the fund money and invest into the project. I'm not having to sign 150 pages of documents. Right? And so yeah, that's why. Great question.
You got any more?
We can have another conversation. We can continue. I can go all day. I mean, we can leave it there.
Good stuff. Okay. Well, thank y'all for watching the Blueprint podcast. Hopefully you learned something today. I feel like this was a podcast where you're definitely gonna have to go do some research after this one. And so definitely spend some time. Hopefully you took notes. Definitely get off ChatGPT. Go talk to some attorneys. Find some people who are doing this. And then also just be willing to add value, right? And I think that's something that we didn't talk a lot about, but I think that's just something important. Is you have to understand what your value is, understand somebody else's value, understand that if you're asking them to help you or you're asking them for money, you need to understand what are you bringing to the table. And we've talked about all those ways of what that looks like, whether you're passive, whether you're the investor, whether you're the bank, whatever you are, you have to really understand that value. And so I think to Laurinette's point, sometimes just knowing when it's time to strike, right? So knowing when it's time to build relationships, knowing when it's time to do the education, when it's time to watch the Blueprint podcast, learn a few things, meet some people, and just know when your time is, but then also take action and take it massively when you do. So thank you guys for watching the Blueprint podcast. If you haven't already, hit the subscribe button for us. We're going to have our sponsor Ross Wilkins with Lending One. In the description, we're also going to have Laurinette and Ryan's information. So if you want to reach out to them, if you're serious, don't waste their time. So if you're serious and you're really to make a deal happen, we're happy to help. So until next time, peace.